Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
You know, we got all this debt. Everyone seems to be talking about all the debt we got and spending bills. I think I saw PMIs. Was it come out today? Didn't look so hot. How do you kind of avoid this debt crisis? Is this a situation? I mean, it seems like the administration wants to grow out of it, but do you kind of inflate some of it away? What do we do about this U.S. balance of payments spiral you talk about? Like, how do we think about it?
Yeah, it's a really narrow path. But I mean, there is a path, but it's a narrow one. And regardless of what path it is, it involves pain. So what we're talking about is really mitigating pain, but there being much more pain regardless than is currently envisaged. And the reason for that is, okay, so if you go back to what I just said, basically the global financial system is very constrained in terms of its ability. If I just think about the banks globally, in the major developing markets, they're constrained in terms of their ability to continue expanding their balance sheets by both particular Basel III capital ratio issues and also liquidity coverage issues. That's one thing. So your credit mechanism or your financial leverage and market making mechanism is sort of structurally maxed out. And then you've got central banks, which globally, as I say, are all contracting their balance sheets all at the same time. And so the total amount of financial capital globally is more or less now hitting this upward limit. And within that context, the US is a debtor country that's running large twin deficits that requires ongoing flows of capital just to maintain existing spending levels and existing market pricing, right? Like the dollar right now, if you're running like a 4.5% of GDP current account deficit, that's the amount of flow that you need to come in and buy your assets to hold the dollar flat. And that flow just isn't really available. And not only that, but, you know, foreigners have a lot of exposures that they're trying to, or so far gradually, but we'll see how quickly this goes, that they're sort of unwinding and diversifying into global assets and global equities, emerging market carry, stuff like that. So this whole rebalancing is a detriment to the US ability to access the capital that it needs to fund these twin deficits. And this is a dynamic that is very usual in emerging markets. People like Brazil have this issue. Normally, in emerging markets, if you're running hot and you've been in this big long upswing for 10 years, and by that time you're running twin deficits because you're overspending your means, and all this capital's come in to enable that. Your currency becomes really expensive, foreigners become really exposed, your economy's running hot, and then all of that stuff happening at the same time means that, like, okay, you're not really a great credit or a great place to put foreign capital because your assets are very expensive, your currency's expensive, right at the time when your fundamentals are deteriorating, your growth is about to turn down and so on. So that's the situation that the US is in now. And so in that context, let's just say, let me like contextualize this, because the thing that's become so extreme since we last talked, what is, aside from the financial leverage underpinning the equity market, is the fiscal position. And part of the reason that we have so much leverage that's necessary to take on all of this debt issuance in the financial system is because the debt issuance is massive. We're running over 2 trillion deficit. And the thing that's different versus the past is that in the past, it was almost automatically financing, in a way, the current account deficit, because Americans would spend on goods. Maybe they'd source debt domestically. They'd use that debt to buy foreign goods. The foreigners would have the dollars, and then they'd put those dollars back into US bonds or deposits or equities or whatever, right? Some sort of investment flow. And so that whole thing was this mercantilist flywheel that we've been on for the last 50 years or so. Really, the last 30, it really accelerated. But the problem is that those countries, when they take those surpluses and they recycle them abroad, in order to accumulate reserves in that way, you're basically printing. So they were doing QE for the last 20, 30 years. as a way to keep their currencies suppressed. But instead of buying domestic assets, they were buying US assets. And the point I'm going to make here is that back then, the US fiscal deficit was maybe a third of the total global current account surplus. Like if you just look at how much surplus dollars are available in the world to recycle into the US bond market, there was ample. And that there's ample even before considering geopolitical rivals and stuff like that. Today, the deficit, because of how big it is, and this whole issue of having basically done a fiscal stimulus at the top of the cycle, so we can't now do it in the recession because we've already done it and we've already financed it sort of to this extreme degree. Now, the US deficit alone is the equivalent of like the entire GDP of Brazil or Italy or Canada. It's like you're spending you're overspending the entire output of a country of 150 million people just fiscally. And so I take that and I compare it to the current account surpluses available to come back in, even if they wanted to, which they don't. But let's say they did. The fiscal deficit's about 3 times bigger than the current account surpluses available from basically all of the surplus countries except for China, who I think, it's a fair assumption that as our geostrategic main rival now, they're reassessing whether it's wise to keep holding this much US exposure, and they're moving into gold. And that whole thing is just a very difficult problem. Like you just have a huge borrowing need, a domestic financial balance sheet limit that's been hit. And so there'll be things like capital relief, like Basel III standards will be watered down and stuff like that to try to give a little bit more flex domestically for the banking system to expand. And if we get a deflationary recession of some kind, then the constraints on easing and printing and all of that stuff start to go away. But obviously, you need to have a meaningfully deflationary recession for that constraint to be lifted in terms of the Fed being able to ease and print. So the way that this goes well, to sort of circle back to your question, and by well, I mean like the least economically painful, and probably at this point, the least overall pain for the asset markets would be in that like slightly, let's say global capital sort of zero sum, US capital's access to, available capital is a little bit less than zero sum, slightly negative sum because people are rebalancing out of the US and into global assets. So you got this capital limit and it's fairly zero sum dynamic. Within that, you basically need people to come out of their equity positions and that flow to go into the bond market and bring down term yields. And so you really need the pie, it's like fixed pie now, and you need it to shift out of equities and into bonds. That will bring down yields. That will save the housing market from its current state of basically a complete freeze. And that helps the government finance properly and at a lower rate and brings down a big part of that deficit is obviously the interest burden, like 2.4 trillion deficit right now. Fully half of that is the interest burden. So if you kind of have to engineer a recession at this point, and the tariffs, to the extent they are impacting corporate profits more than they are passed through to consumption, a recession will help with that, because in that kind of an environment, you can't really pass through all these price increases without seeing major volume reductions as a retailer. So the burden has to fall on the 10% of the population that has benefited the most from the bubble and the fiscal spending and all of the globalization in the past 20 years. And that's basically the corporate profit share of GDP. And it's also the equity owners, which are sort of like the top 10, the top decile of the population. And by doing that, you can kind of save the broader interest rate sensitive economy and distribute the pain in a way that sort of matches where all of the spending went.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.